Welcome to Fitz Factor, the show where you learn how to master the stock market with Dan Fitzpatrick, the stock market mentor. Dan is a savvy trader. He's featured regularly on Fox Business, CNBC, Investors Business Daily, and SiriusXM Radio. In this podcast, Dan shares his insights on trading, life, and attaining long-term success in the market.
Dan, I'd love to expand on your morning note today because I think you said some things that are really powerful. So in your morning note this morning, Dan, you commented that we're in a wow environment, and you suggested that the market is climbing a wall of worry, but that the wind is at our backs for the bulls. Can you please explain what that means, how traders can identify that for themselves, and then how you like to position yourself when we're in this type of trading environment?
Yeah, sure. It's a really good question. And most traders, you're familiar with this term, but a lot of times people don't really understand the nuances of it and why it is what it is. As the old saying goes, the market climbs a wall of worry. And this is how that works out. There's always something to be concerned about. Peter Schiff, who's one of the smartest guys that I've ever met, has been right about his concern for the stability of the dollar and various other things and how gold is the place to be and Bitcoin is crap and all that jazz. I think he's right about all of that. Although with respect to Bitcoin, he's totally wrong on that simply because what's worth more, the dollar or the Bitcoin? Okay, well, look at the damn charts. You tell me. But both of them, the only value that they have, because I hate to tell you guys, but we're freaking broke as a country. We're so deeply in debt that American Express would not raise our credit limit. It just so happens that we get to set our own credit limit and it's infinity. But the only reason the dollar works is because people have faith in it. And I'm making a point here. It's the same thing with crypto. Coins that are 3 cents or something like that. Okay, well, those aren't really worth very much. But the ones like Bitcoin, Ethereum, Solana, those are worth a lot of money. Why? Well, because people think they are. Period. That's the end of the deal. This is psychology. And now we're getting back to the wall of worry. Well, I'll finish my thought on Peter. So he's right about all of that stuff, but the charts of saying, well, you may be right, but we don't care. And so that's a worry. People are worried about that. You're worried about the election and what's going to happen, like the war in Israel, Gaza, Ukraine, all these various things. Meanwhile, the market just goes higher because the market is the voting mechanism. You are the worrier, and you don't want to be the worrier. You want to just look and see what the market is doing and then just go along with that. One of the times we went in and lobbed bombs on Iraq or Kuwait or wherever the heck it was, the market had been trending down lower and lower and lower as tensions got higher and higher and higher. And the first big explosion that you saw was the beginning of the explosion in the market. Suddenly, stocks started moving higher in a big, huge way. And why? Because all that worry was already factored into the price of the stock. And then once the bombs started dropping and the shells started firing, that actually created some certainty because it's like, okay, well, could things get any worse? And once the market realized that they really couldn't, then stocks started going up. Same thing in 2016 with the election. If you guys remember, the consensus was that Hillary Clinton was going to win. Like Trump's winning was a huge surprise. And I remember because we were up late watching the election that the futures really, when Trump first looked like, oh my God, Orange Man is going to win. The future started trading down massively. Like it was like, oh my God, it's Armageddon. Then the next day when the market opened, that was the bottom right there. And that's neither for or against Trump as much as it is, okay, now we have certainty. We're no longer uncertain. We're no longer worrying. Now we can start moving higher. Okay, so with respect to this wall of worry, there's always stuff to be concerned about. And because there's stuff to be concerned about and news is what it is, you and me, the average guy on the street, there's always stuff to worry about. And that means that people that are worried, they're worried about the market going lower. They're worried about their profits slipping away. They're worried about buying right now. Like, I don't want to buy right now. In fact, I want to sell. So they liquidate their stock into cash, and now they're happy because they've gotten out. So all of that, and we're talking about the crowd as opposed to one person. So they get out of the market, and their getting out is a reason why stocks peak and then start coming down. And so for a short period of time, they're looking at this like, man, I top ticked the market. This is awesome. Woo, I made it. Now I'm not so worried. Meanwhile, there's the other side of the trade, and that is maybe people who have a lot of cash who are waiting for an opportunity to get in. Remember, wall of worry, we're climbing it. So the people that have been out or just savvy traders, they're going to sit in and go, okay, now I don't have to worry about buying at an all-time high because I can buy this little pullback. So their buying soaks up all the supply created by the worry warts, and that creates support. And once that support shows on the chart, now you're going to get more traders coming in saying, oh, this is my opportunity. Then the market goes higher or a stock goes higher. It breaks out to a new high. And then what happens? Well, all that stuff that you're worrying about, guess what? It's still there.
If you're getting value from this podcast, click the subscribe button and sign up for Dan's free daily videos at stockmarketmentor.com.
It's still right there. But at the same time, you're going like, now you've got FOMO. Before you were fearful, but now you've got greed going in your favor. And so you get like, okay, crap, I made a mistake. I got to get back in. So now you're buying. You and the millions and millions of traders who are doing the same thing as you are getting back in. And it's that buying that's kind of like the fuel for the fire. It creates a bigger fire and more uptrend. And so what is this? Again, it's a worry. It's a constant worry, but that wall, you could say rather than it be a wall of worry, which is kind of pithy, you could look at it really as like a staircase, but it's always going up, except various times when this pulls back. But this is what I want you to be thinking about. And I talk about the weekly charts. And for people that are listening to this as opposed to watching it, I'll kind of describe it so that you can kind of play along, so to speak. But Wyckoff, there are many people, Weinstein, Wyckoff, Fitzpatrick, have a certain way to look at the market. I'm not talking about the trends, uptrend, distribution, downtrend, accumulation, lather, rinse, repeat. I'm talking about the things that actually move stocks. And this is really how it works. Institutions that like Fidelity or some of the Vanguard, these big mutual funds or these big JP Morgan or you name it, or huge wealth managers, they're looking at buying stocks that are going higher. They're the ones that are actually creating the orders. They're subcontracting those orders out to other firms that are actually filling those orders. So the institutions are the decision makers. Okay, remember what I said, weekly chart for decisions, daily charts for actions. Now, we can look at that and we can see what institutions are doing by not looking at the daily chart. I'm looking at the S&P 500. This is a mess. It's all over the place. Institutions are doing this. You're looking at the weekly chart, and generally speaking, you see higher lows and higher highs. This is not distribution. Remember, I talked earlier about the up-down volume ratio being 1.7. Anything over 1 signals accumulation. So we look here and see institutions are buying. These are the decision makers here. And then so they make a decision and go like, okay, hey, Paulie, I want you to buy $500 million worth of such and such a stock or whatever the number is. And so what do? What are the desk traders like or the manipulators is what they're called. The operators are the big guys, the decision makers. The manipulators are the ones that are actually trading the stock. And what they are doing, you could say they're manipulating the stock, because what they're doing is they got to fill the orders at the best price possible, but they know it's going higher because institutions, give me a $500 million share or a $500 million, whatever. So they know the stock's going higher, but it's not going to go in a straight line. So you can see what they are doing by not looking at the weekly chart. We know what the institutions are doing. They're buying. Okay, this is why buying within a base is kind of silly. Why are you trying to get ahead of institutions? I want to ride on their backs, the wind beneath my wings. so to speak. Then you look at the daily charts. Now you see what the operators are, what the manipulators are doing. And this is why stocks ebb and flow. They go up and down. And that is because somebody who's filling a massive order and it's probably spread out over various desks, they could be doing that for a year. Some of these buying campaigns go on for a long time, but they're not just going to be buying every day because then they're bidding against themselves. So what they do is they'll look at these key moving averages. They matter. And they will look and say, okay, I'm buying the stock. This is back down at the 50-day moving average, which means the average price over the last 50 days. That's pretty good to me. And so they start buying the stock right there. They see average price over the last 50 days. I'm not going to get fired for filling it there. And so they start buying stock. They all do it. It's a collective thing, which is why 50-day moving averages work. You can apply it with the 200-day as well, but that's for another conversation. So this is why the 50-day moving average works, because they're all looking at the same thing. Nobody's going like, oh, I know, I'll get a head start by using the 47-day moving average. That's silly. Nobody does that. Everybody uses the same reference point. So when the stock or the market comes down to that level, they tend to say, this is my opportunity to buy if they have a big order to buy. Okay. So then when their buying starts pushing the stock higher above the 50-day moving average by a lot, they say, okay, well, I'm glad I got what I got, but I'm sure as heck not going to be buying it up here. It just raises my cost basis. So then they stop buying, or they really go lightly, or maybe they even sell some. And then that's when the stock comes back down. And then they look to buy it again right around the 50-day moving average. So what's happening to the average guy on the street is buying and really, really happy because he's already seen the stock break way above the 50-day moving average. So, oh, I know for sure this is a winner. And then when it starts pulling back, they get freaked out and then they sell. Why? They've been worrying about things. And so now it's like, I got to get out of here. So they are actually on the other side of the trade of the manipulators, of those that have enough firepower to actually be affecting the price of a stock or of the broader market. And that is the wall of worry. And one thing you got to keep in mind, and this is really important, like the market's not rigged against you. I'm sorry. But if that's what you think, then you need to maybe go to barber school or maybe get an electric mower and start mowing people's lawns. But you're not a trader if you think the market's rigged against you. It's not. You're rigged against you. If you look at stocks without understanding about the wall of worry, always stuff to be concerned about. Look at the trend. Is the market concerned about it or just you? That's what you do. And if you see that the market's not worried about it, so why should I? I'm not really smarter than the market. This we know. And so if you're looking at that and you're seeing that it's this wall of worry, that everything is climbing like up the staircase, then you want to be on the right side of that. But you also want to know. So then you know that institutions, the operators, those that are really putting in those big orders, they're buying. So you want to be doing that too. But you don't want to be buying. You want to have bought. You want to already be there. You don't need to buy 90 gazillion shares of something. You just buy what you buy and then you're good. Let somebody else do the work. Now you're not climbing the wall of worry. You're just sitting there watching it happen. So if you haven't bought though, but you understand this technique, you have to be thinking about trading along with the manipulators, along with the order fillers. Don't take the other side of their trade. If you're taking the other side of their trade, that means you're buying when they're selling and you're selling when they're buying. You don't want to do that. And so if you find yourself doing that, you are actually part of the wall of worry as opposed to the trader who has an account that's climbing it. Don't be a victim in this type of thing. You want to be a victor, and that comes from mastering yourself, like your own emotions. But the only way, I'm just telling you from decades of being a loser, not decades, but I started out that way. But the only way you can master your mind and be doing the right things at the right time is if you truly understand the market dynamics. And I've just explained a really, really critical element of understanding the market dynamics. Get what the wall of worry is, figure it out, and then exploit it. Get on your climbing shoes, go on belay, and then start climbing up there. And then when you get up to the top, you'll be able to enjoy champagne and caviar. I hate caviar, as opposed to drinking Mountain Dew.
Dan, I think you've made some really important points here. Even just looking at the chart that we're looking at now, off the low in October of last year, scroll back a bit, we see the market coming off of the low and printing what Investors Business Daily and Bill O'Neill call a follow-through day. And if you have that as part of your entry criteria, waiting for a follow-through day, there was a ton of stuff to worry about in October and November of last year, if you remember.
Oh, yeah.
But the market printed a follow-through day and held back above that 50-day moving average, that key moving average that you're talking about right now. And so even throughout that moment, in your mind, you're like, okay, there's a lot to worry about. And we haven't beaten inflation yet. Rates are still high, et cetera, but the market is moving higher. And so what you're talking about is removing yourself from that deluge of news headlines of all the reasons on CNBC and Bloomberg on why not to buy stocks right now. And you're following the price action. And then as the market continues higher, it's climbing that wall of worry. And so if you're standing back and you're worried about things, but you see the market go higher, that's how in your mind you say, okay, it's climbing the wall of worry right now. I need to get on board with this because otherwise I'm going to miss out on what could be a huge trend.
Yeah, you raised some really, really good points. And this is a great example of this. And you guys, you got to think about this. So on October 27th in 2023, that's when the market put in a big bottom. And then it starts rallying. And over the next, week or so of trading sessions, 1, 2, 3, 4, 5, the S&P climbed quite a bit, like almost 6%, which is a lot in 5 or 6 trading sessions. But it was still below the 50-day moving average. But you could say, oh, crap, I missed the move. Well, now we've got this day that I think you're talking about here, Scott. I mean, there's some follow through days down here, but then this big move on November 10th, which occurred right about on average volume. But this established the 50-day moving average, which had been resistance. That's where the institutions are selling. That's where the manipulators are selling. We got to get the heck out of here. Okay. And then on these big pullbacks, that's when they're buying. They bought one right at the 200-day moving average. Then they buy more on this day, on this first move higher, this October 30th, 2023 day. But then finally, this gets above the 50-day moving average decisively, which you will note the 50-day moving average is still actually drifting lower. But if you said, well, screw that, I mean, the market's moved up 7%, but this is my signal, I'm getting on board. So you're buying here, you've missed a 6% move. But then over the next 5 months or so, the S&P is up 20% from there, from where you bought before it fell lower. And then it wound up doing the same thing again. So the bottom line is, if you have as a part of in your toolbox, I only buy stocks that are above the 50-day moving average. If they're not above the 50, they're just not in my wheelhouse. I'm not going to look at them. If that's your rule, you would do really, really well trading S&P futures if that's what you want to do. If you just use this basic indicator as your reference for what's good, what's in the bad hood, that's your big list to work with. And if you look back here in October of 2023, when the markets started going higher, why did it do that? Because this is what was happening. Oh my God, could things get any worse? It's horrible. Oh my God, the wheels are coming off the wagon. Could things get any worse? And then somebody goes, oh my God, I don't think they could get worse than they are right now. This is horrible. And somebody else is looking at it going, yeah, things can't get any worse. So guess what? Only better. It's an opportunity for growth. And then the market starts moving higher. So when things just can't get any worse, that's the time to say, what are the operators doing? What are the manipulators doing? If they're buying, I'm in. If you could be mindful of that type of thing, I just promise you, you're going to do really, really well. You're going to be taking advantage of these pullbacks on the yen carry trade, which doesn't mean a thing to you or me. And it doesn't have anything to do with the value of Microsoft. It's just a bunch of dumbass hedge fund managers leaning on this trade that everybody's already in. And if everybody's already in the same trade, then all it takes is some finance minister or whatever with a Japanese name to burp. And then everything falls. And then suddenly the yen carry trade is busted. Everybody's selling. And then, by the way, so then what happens? This comes up. The finance minister in Japan says, you know what? We kind of made a mistake. Maybe we want to drop interest rates again or whatever. And then what happens? Carry trades right back on. So it's like the same thing happens again and again and again. But none of this impacted the value of Microsoft. Yet that went down. Of NVIDIA or Meta. None of this had anything to do with any of this stuff, yet it created a big move in the market. My point is, if you understand that kind of thing and you go, wait a minute, why is the market doing what it's doing? And is this really impactful on my particular positions? And if you know a little bit more about market dynamics, you'll go, oh, I know what's going on. Because these hedge funds, because all these investors are upside down in the yen carry trade, they're all getting margin calls. They've got to raise some cash in order to either stay in that trade or to get out and still be able to be in business. So they have to raise some cash. So what do? They don't call their mommy. They start selling stuff that they can get money for. And this is why some of the moves in the market are totally nonsensical, because you're going, wait a minute, why is this stock selling off just because that's happening? Well, if that was a really crowded trade, a lot of folks are needing to raise money. And so they'll sell the stuff that they can. They'll sell the stuff where there's a real bid for so that they could get the money to cover their margin or do whatever they need to do. So once you understand this type of dynamic, that's your edge. You have two edges. Understanding market dynamics. If you don't understand that, you're a dull knife. You're always going to be a victim if you don't understand market dynamics. So understanding market dynamics is your edge. The other edge is you have a process that you follow fiercely and consistently. So knowledge plus a process that you stick to. If you've got those two things going for you, you have a massive edge and you can knife through any issue.
Thanks for listening to Fitz Factor with Dan Fitzpatrick. If you like this, then you'll love Dan's premium service at stockmarketmentor.com, where you can learn how to trade stocks, options, and cryptocurrencies. Click the link below and get access to real-time trading alerts, a community of traders just like you, and live training sessions each week. Get the trading edge that you need at stockmarketmentor.com.